this is Abhijit Chatterjee recording our weekly session of Chatsarefun. This is for the week of June 9th, recording this on June 15th in the evening. Last week, the market was coming along quite well, had rebounded like the tame CPI and PPI data, was feeling quite good with respect to the momentum till late Thursday evening. We found out about the strike of Iran by Israel. Oil prices shot up, market had volatility spike, did sell off, and into the weekend, we look at what Bitcoin is telling us. Bitcoin trades 24/7, as we know, so we'll see how it responded into Friday and then over Saturday and Sunday. We know that the 10-year yield is something to watch. There is the Fed meeting, FOMC's meeting on Tuesday and Wednesday, so we'll find out from Chair Powell their thoughts on interest rates, their thoughts on the market overall, the economy. Their press release on Tuesday afternoon. So the press release comes out at 2, and then at 2:30 they have the press conference. So we'll see what he has to say there. But if you look at what the 10-year yield is telling us, we'll look at the chart of TNX and talk a little bit about S&P 500. You know that S&P 500 has come up a lot since the April 7th low at 48.35. It has come very close to within a couple of percent of the high that it saw in February. It did pull back on Friday after the Israel attack on Iran. Over the weekend, we know that Iran did strike back, so this could turn out to be quite, volatile. Unfortunately, it could both with respect to escalation on the situation there, not just impact the oil prices shooting up, but could hit the market not liking the volatility that's out there. So with that, just straight into our blog site. It's in Substack. Appreciate you subscribing to it. If you share your email, we'll get it to you as it comes out in the morning around 7 a.m. That's our website in YouTube. It's our channel called Chartsarefun. Appreciate you subscribing to the channel. And if you could hit the like button, we really, really appreciate that. CBS Marketwatch. This is the headline page right now. If you go there, it talks about the Fed meeting, and we all know that market is intently watching the Fed meeting. There's been a lot of talk of stagflation, where the economy stagnates, the GDP pulls back, and then inflation kicks in because of tariffs. And now with oil prices shooting higher with the Middle Eastern crisis, perhaps inflation kicks back in. So that's the concern that Fed may express into middle of next week when they meet, and market thinks that it would not help stocks break out to new highs. We know that it's came pretty close to the February high of February 19th high of 61.47, and we'll see what the charts are telling us. The 10-year yield, let's start with that, is key. That's the long-term Treasury. It had a good auction last week, but that said, on Friday after late Thursday night, the Israel attacked on Iran, we can see that the yields did move up higher. It moved up by 0.67. So it moved from from 43.6 or so to 44.24. So it's 4.42% is where it ended. But we can see that this is an ascending triangle. An ascending triangle with higher lows and a resistance level at 4.6 is where the horizontal line is. A break on this measures to 38.86 to 46.29. So that you're talking about roughly 7.29, and then this 38.86 is about 14.14. So that measures closer to 53.58 plus the 14. So that's 53.72. So that's 5.37% is what the 10-year yield could result in if this ascending triangle breakout happens. That would not be good for stocks. If you have a 10-year yield shooting up that much, that would effectively mean that the small caps would lose their rally. They have been acting quite well recently, and it would definitely make an impact with respect to money kind of going out of the speculative sectors and moving more into the defensive sectors, which we know staples and utilities tend to benefit from it. But with 10-year yield selling off, utilities often may not, because they tend to correlate with the bond market as well. So the 10-year yield shooting up means bond market is selling off, and it could effectively just money moving out from stocks and bonds, and then just going to staples or going to other safer instruments, maybe just into shorter term cash and shorter term treasuries. So we'll see. This is something that the bears are rooting for, the bond bears. They are rooting for this to break above, and they are looking for a 5 handle or higher on 10-year yields, and that would not be good for the market. We said we're going to look at Bitcoin because Bitcoin we know does trade 24/7. So this candle, this is a nice bullish reversal candle, tested the rising 50-day moving average shown in blue and the 200-day moving average shown in red. They're both climbing. We can see that the 50 is at 103.6 thousand and the 200-day is at 95,600. We see that it did cross above the January high. That's a bullish sign. The fact that Bitcoin took out the January high, printed a higher high above the 109,000 and 112, nicely pulled back and tested its rising 50-day, came back to sharply to 110,000 and tested the 50-day again the second time. And so far, and that is the day on Friday. So we know that the intraday spike coming lower happened after the Israel strike on Iran on late Thursday night. By end of the day Friday, typically this Bitcoin market ends around 8 p.m. Eastern time. So 8 p.m. Eastern time, it had already pulled back and closed positive, and we can see strong volume on that recovery. So that's a bullish candle. That's a bullish reversal candle. And then into Saturday and Sunday, we can see a long, reasonably reversal wick as well. And then so far, it's kind of forming a bit of a doji kind of open and close. We are getting very close. We are actually past, actually this, let's refresh it. We are already past Sunday now into Monday because we are past 8 p.m. Eastern right now. So we can see that Sunday it managed to close positive as well. So we can see that it's no longer red. It closed slightly above its open tight candle, but this is in some ways forming a bit of a pennant shape. The highs and the lows are kind of converging into a triangle. So we'll see what ends up happening overnight into tomorrow. We know that the escalations of the wars usually happens late nights, which is already past like 2 or 3 a.m., maybe 7, 8 hours is where Israel is right now. So they're already right now past like 3 or 4 a.m. And we'll see what else happens tomorrow morning when we wake up. But the Bitcoin does reverse and make a higher high above the 110 from 100.4 to 110.5. That's a 10,100. And add the 10,100 to 110, you're talking about 120,000. It's possible. I could not rule that out. If I consider this as a cup and handle, we can see 110 here to 100, back to 110. A bit too sharp of a pullback for a handle. Handle is usually shallower. But if not a cup and handle, it would be an ascending triangle at the 110 as the horizontal line of resistance, and the the lows are at higher lows. So 100 and then 102, and then maybe another higher low, and then it breaks out. So far, Bitcoin is signaling that it feels that maybe there'll be some form of a settlement, some form of resolution between Iran and Israel. But at this point, there's still a possibility the bulls would look at this as a potential possibility of a Bitcoin breakout above 110 to run to 120. Let's look at S&P 500, and this is the 10-minute chart. We can see that gap down that came in on Friday after the strike overnight on Thursday night. So we can see that this is 6,000 level was the key support. It went up to 6,059, so about 60 points, broke down below it. So that's roughly, take 60 points to 6,000, 59.40. We didn't quite get to 59.40. The low was at 59.64. But as the market printed lower lows on S&P 500, we can see that the 10-minute chart shows positive divergence in RSI, higher low. And the same with MACD. MACD is at a higher low, the histogram. So that indicates potentially we could see a recovery of S&P into this week. It's again, just one day is too hard to tell. If potentially, as I said, the breakdown from 6,000 to 6,060 is about 59.40. We still 59.62. So it's about 20 more points potentially. It did reverse a little bit of the losses from the lows of the day and ended near 59.76. But visiting 59.40 is 36 points. We could easily get there tomorrow morning when it opens. But the 10-minute chart so far looks bullish and it looks positive divergence, and we shall see what it ends up doing tomorrow morning. The S&P daily chart does show a bit of weakening of momentum. Why? Because it has climbed. It has climbed in a sharp V shape from the 48.35 to a 60, 59 or 60.60. Not too far from the 61.47 February 19th high, but the RSI is printing lower high, and so is the MACD. And the fact the MACD over the last entire couple of weeks has been flatlining below the center zero line. This kind of flatlining indicates indecision. It indicates that the market's momentum is waning. And you could say this is also a negative divergence. So draw a line from the MACD's high to the recent MACD at a lower high with price climbing a higher high. So a lower high in RSI, a lower high in MACD. Bears would point this to be a negative divergence, and potentially, yes, there is a possibility that we could come back, test the rising 200-day moving average at about 5,800. And if it gets worse, pulls back further, the rising 50-day moving average is 5,667. And we know that there are gaps here around the 50, below 5,700. There's a gap right here. This gap is way lower. This gap, if it has to fill, would mean retest of the lows. It's unlikely. We feel that potentially if S&P does pull back, it's going to be a shallow pullback, and we do see a potential rise. The reason we are bullish is look at the accumulation distribution. This indicates strong money moving in. It means smart money accumulating as S&P is climbing. Usually if this diverges, as when the market climbs and the accumulation coming down, that's bearish. So this is where when the market was coming down, you can see the accumulation also initially fell, but it was flatlining. Overall, this entire waterfall decline that we got, notice that AD did not tank. AD stayed flat and then started climbing. This means smart money was considering this as a buying opportunity in what we just got from the tariff-related sell-off from February into April. Smart money has been buying as they have been accumulating, indicating we see an upside breakout. We see potentially a breakout above 6,200 all the way up to 7,000 plus is where we are looking at the market. We shall see how the 50-day turns higher and crosses bullishly above the 200-day. Is still a few weeks off from that. Near term, yes, there is potentially this negative divergence could play out and we could see the pullback, but not much of a sharp pullback. We expect this to be a shallow pullback and then from there a climb higher. Another bullish indicator is the bullish percent. This is based on point and figure charts. Look at the 500 stocks in S&P 500. What percent of the stocks are indicating bullish point and figure charts? It went as high as from the low of 10% of S&P 500. That means only 50 stocks had bullish looking charts, went up to 76, and then from there pulled back to 68 and hovering around in the low 70s. This also indicates that the pullback that we've got so far, the bullish momentum hasn't deteriorated as much. It's been maintaining the 70% or higher bullish momentum in the charts. You can see that the MACD histogram for almost 2 or 3 weeks has printed out a histogram below the center line and poised to cross and go higher. So while many are expecting the pullback and so on, potentially we could climb up just using the Bitcoin as the leading indicator that it printed a higher high above the January high. There's a possibility that S&P could print a higher high above the February high, hit a 6,200 kind of a target before the pullback comes towards the 5,700. So that's a possibility. So bullish percent index indicating that there is potentially a chance of bullish percent index improving into the next couple of weeks. Another short-term indicator, which is a market momentum indicator from advanced decline called the oscillator, McClellan oscillator, and that we notice that has dropped below the zero level. It's negative. It typically goes as negative as when it's deeply oversold to minus 100 towards the plus 890 to 100 level on the top. So we can see that it sharply from December into January had switched from minus 100 to 81. Then over the time period from there till March into lower lows into April 7th had come from 81 to minus 90 and then a sharp reversal from there. We know that after the tariffs were paused on April 9th and then moving forward, it very strongly rebounded. And the last month or so, though the market has been climbing, this is indicating market's momentum in front of the oscillator weakening. So there is a possibility the oscillator would say it could indicate the MACD histogram is about to turn below. So is the RSI about to turn from the 40 towards the 30 level. It's possible that if this breaks down and keeps coming lower, this directly correlates with the market moving lower. So if the oscillator goes from minus 15 down towards the minus 90 level again, we feel that there is a possibility that then the market could see a little more pullback towards, as we said, potentially we know, but S&P potentially could test this 200-day moving average at 5,800 and down towards the 5667 to close out the gap. So that's that. But then if you look at summation index, which is a intermediate cycle indicator, fluctuates from minus 1100 to plus 1100, it has tested that plus 1100 level price in the last 2 years or so, tested it around February, it tested it around December to January of December 23 to January 24, and then more recently around between September and October of 2024. Right now, it is climbing off a higher low. We had seen that in the October 2022 bear market bottom, it tested minus 1138, then it tested a higher low at minus 834 in October 2023. And then into 2025, April 7th, it printed a high low at minus 590 above the 834 and minus 1138. That now could climb back for the cycle to kind of come towards its bullish momentum overbought level, it could come back towards 1100 as a possibility. And that notice had climbed for 6 consecutive weeks. This tends to be a monotonic climbing kind of an indicator. It doesn't just keep circling back and forth as the McClellan oscillator does. That does keep fluctuating back and forth quite short-term wise. This one kind of moves intermediate. So once it has started climbing, we noticed that 3 last successive weeks it had declined. Last week it started climbing back up again. So we shall see what happens if the FOMC is not as hawkish as many are thinking. If they give any indications that they're going to be supportive of rate cuts, they do see the inflation coming down, CPI and PPI, and they're worried about the labor market. They have dual mandate. The Fed does care about the labor market. They do care about unemployment. Claims have been creeping higher. They do worry about the job situation weakening and that impacting the economy. So if they're going to focus on that and kind of for the time being, take a bit of a patient view on the inflation, because so far inflation has been fairly tame. They could give you some indications maybe about cuts. They have right now expectation of 2 cuts this year, but perhaps they may give indications that that could come as soon as July. So we shall see what they do. At this point, market is expecting Fed to be extremely neutral about declaring anything on rates and just to stand and watch is what they would do. Oil prices is an indicator of what happened in the Middle East. We know that they are very sensitive to strikes in Middle East, and this we can see has broken out. This broke out even before the actual attack happened. This gap higher was after the Thursday night into Friday. So this is crude oil prices. So this is West Texas crude. We can see that there is an ascending triangle between 56 to 64.8. So that's roughly 8.8. Add 8.8 to 64.86. That gets us to 73.6. It met the target. We see that it opened at 73.36, went above the 73.86 target, touched 74.02, and pulled back and closed towards 73.18. We shall see. I mean, it's not been like anything with respect to de-escalation on the Iran-Israel. Israel got hit a little bit on Saturday and Sunday, and then they hit back on the oil fields now. They started off with the nuclear sites on Thursday night, but over the weekend into Saturday night, they've now started attacking the oil fields of Iran. So it is escalating. It is prone to perhaps even rise back towards the 80 level. The next key level of resistance, you can see tested 80 in August. Test came close to testing 80 in early January. Potentially, if this climb continues, that's where we're headed in West Texas crude. So that would in some ways indicate for the summer season higher gasoline prices, and it could indicate potentially inflationary concerns because oil prices, from a core inflation has a big part to it. Oil and food has a big part to inflation. The core takes out food and energy, but core has been benefiting from the apartment costs, the housing prices, the housing costs coming down. That has helped the core inflation coming down, but the full consumer inflation does have an impact with the oil prices. And if oil prices have kind of broken out, and if they can keep climbing towards that 80 level of the West Texas crude, that could effectively get Fed concerned about inflation. So with that, sum it up, we see CBS Marketwatch talks about not expecting much of any stock benefits from the Fed meeting. So there is expectation that Fed will, if any, dampen the climb. The bond bears would be looking for this breakout of 10-year yield, and that would be bad for the stock market. If this breaks up from the 4.6 measured to the measured target of 5.37, that's significantly higher from where we ended at 4.47. So 4.47 or 4.42 to 5.37 is quite a bit of a climb, 90 basis points almost, and over 90 basis points. Bitcoin, we feel potentially could be bullish. The fact that it reversed on Friday, yesterday, just about till 8 p.m. on Sunday night. It closed on Sunday. Now we started Monday trading. Wants to kind of break out of a pennant into a higher rise. If it does break on 110, we're going to a higher high to 120. So that is a bullish indicator in terms of how Bitcoin is seeing this play out. S&P's 10-minute chart indicates positive divergence, which means looking into Monday, Tuesday, we shall see if it means that S&P tries to reclaim and climb back above 6,000. The daily chart does indicate bearish signs of negative divergence. RSI at a lower high, and so is MACD, which means we could break down towards the 5,800, and that's the 200-day, and if that fails, further down towards the 5667, the 50-day. And the oscillators are giving mixed signals. The bullish percent index seems to be hovering and holding strong at 70%, potentially climbing back to a higher high towards the 80 level as we had in September. That's a possibility, but the oscillator has turned lower in negative region of -15, could come back towards the -90, which could bring more downside in the market. Summation index, which is an intermediate term indicator, it's got more to climb to top out near the 1100. It's right near our midway point, or 626. So if that keeps climbing the next few weeks, that could indicate some market strength. That good luck investing. We'll talk to you next week. Thank you.